housing market is flashing warning signs reminiscent of 2008, rising household debt burdens, persistent inflation, and home prices that are outpacing incomes. While the lending standards are stricter today than they were before the 2008 crash, that doesn't mean we're immune to market corrections. The central challenge is this: when housing becomes unaffordable for the majority of the population, demand eventually collapses. And when demand collapses while supply remains high or increases, prices have nowhere to go but down. This isn't fear-mongering, it's basic economics. What makes this situation particularly concerning is that, unlike previous market cycles, we're dealing with multiple pressures simultaneously: inflation, high interest rates, student debt burdens, and a generation of potential home buyers who've been priced out of the market entirely. The first and most obvious warning sign is the severe affordability crisis we're experiencing right now. Home prices have risen 52% since 2019, while wages have grown just 30%. Combine that with mortgage rates hovering near 7%, and you get a market that's functionally closed to a growing number of Americans. Let me put this in perspective with a simple example. Imagine you're a teacher making $50,000 per year. 5 years ago, you might have been able to afford a modest home in your area. Today, that same home costs 50% more, but your salary has only increased by 30%. Meanwhile, your monthly mortgage payment has nearly doubled because of higher interest rates. This isn't sustainable. When the majority of working families can't afford to buy homes, the market becomes dependent on a shrinking pool of buyers. First-time buyers, FTBs, are facing the toughest conditions in decades. Last year, just 1.1 million FTB purchases were recorded, representing a significant decline from historical norms. The mathematics are simple. If median home prices are $400,000 and median household income is $70,000, families need to spend nearly 6 times their annual income on housing. Historically, the healthy ratio is closer to 3 to 4 times annual income. What's particularly concerning is that we think rising incomes can break the US housing market's logjam nationally in about 3.5 years. But for large cities, we see an average of over 5 years. This means the affordability crisis isn't a temporary blip. It's a structural problem that could persist for years. When housing becomes this unaffordable, one of two things happens. Either wages need to rise dramatically and quickly, or home prices need to fall significantly. Since wage growth typically happens gradually, the more likely scenario is a price correction. The second warning sign is the combination of increasing inventory and stagnant buyer demand.